Okay, so we can go on, Abi. So we've been able to explain enforceability of the rights and obligation in a contract as a matter of the law. Contracts can be written, oral, or implied by an entity's customary business practice. All that has been cleared. Are we on the same page? Then for the purpose of applying this standard, the contract does not exist if a party to the contract has unilateral enforceable rights to terminate a wholly unperformed contract without compensating the other parties or parties. Now, what do we mean by that? Sorry. There are instances that we will have put in as a clause in the contract agreement that either party can actually terminate the contract. So IFRS 15 is saying that if you have such without compensating payments, right, then it does not qualify as recognizing for revenue within the purview of the standard. But if they are compensating payments, either whoever that have defaulted in their obligations, we can then recognize the compensating payments as revenue that has no further obligation to anybody. You understand? Then therefore, a contract is only unperformed if the entity has not yet transferred any promised good or service to the customer. So you have not, just like in your case then, until we see that, oh, there is actually tangible goods or service that have been rendered. The contract has not been, have not been fulfilled. The entity has not, has not yet received and is not yet entitled to receive any consideration in exchange for promised goods or service. So if those, we are looking at identifying the contract. So you need to see and be able to assess the possible impact of that very contract. Not to just say, oh, maybe we have an agreement that we are going. If the agreement says that either party can nullify the contract at no cost, it's not an enforceable contract. What are you enforcing there? Do you understand? So all of these terms need to be verified before you can then say, I have a contract. Features of the contract. The standard goes further to explaining what are the features you should look out for. An entity shall account for a contract with a customer that is within the scope of this standard only when all of the following criteria are met. One, the parties to the contract have approved the contract. So they have that commitment to be of mutual obligations to each other. Otherwise, it is still as good as an unenforceable contract. Two, the entity can identify each party's rights regarding the goods or services to be transferred. One party should then be the deliverer of those goods or services, while the other party will be the one that will take charge of the delivered goods or services and pay a consideration, right? Then the entity can identify the payment terms for the goods or services to be transferred, right? It should then be very clear. In what currency are you paying? How much are you paying? Right? What is the exact consideration for the goods? Even if there are possible warranty conditions, discounts or whatever, let it be very clear that this is the actual consideration. Then the contract has commercial substance. That is the risk. The risk then, if you don't deliver, this is what then happens. The timing, the delivery period for the contract, or amount, that is the consideration for it, amount of the entity's future cash flow is expected to change as a result of the contract, right? Then it is probably that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. Even if on my own side, we agreed a sum, we know exactly what to do, we agree the timing, we know the risks and the likes, but it is then probably that the supposed customer is incapacitated to paying or discharging his own part as a consideration. Do you understand? Then we don't have a contract, because the amount then will become a contract asset in my book. You use contract asset or receivable, whichever one you want to use. Contract asset in my book indefinitely. Who will pay? So you need to see these features before you can then say you have a contract. Sometimes you could have combination of contracts, right? An entity shall combine two or more contracts entered into at or near the same time with the same customer or related parties of the contract of the customer, and account for the contract as a single contract if one or more of the following criteria are met. Do you understand? One, the contracts are negotiated as a package with a single commercial objective. You will do tax services and prepare the account for me. So there is two. I could have given to you that, oh, do my audited account. And a few period not too far from each other, I say, I want the tax services too and my TCC and all of that. Something not too far from that, the timing are not too far. So I may choose to report that contract as a single contract. Then the second one is that the amount of consideration to be paid in one contract depends on the price or performance obligation of the other. Do you understand? So this is what we have as. Then the third one is the goods or services promised in the contract, or some goods or services promised in each of the contract as single performance obligation. So you want to be able to relate them or interpret them as though they have a single-ended purpose, or they are contracts that have unrelated performance obligations, deliverable goods or services as the case may be, right? Then, if you have fulfilled all of that, then we then say you have identified the contract, right? IFRS 15 shall be applied if when a contract with a customer does not meet the criteria for recognition and an entity receives consideration from a customer, the entity shall recognize the consideration received as a revenue only when either of the following events has occurred. And then addressing your concern. I have a consideration that has been received, but no obligations in view, no committedness in view at all. You can only then recognize it as a revenue on this condition. That the entity has no remaining obligation to transfer goods or services to the customer, and all or substantially all the consideration promised by the customer has been received by the entity and is non-refundable. That is when I then said I will circularize the contractee. If he says, don't worry, leave that guy, I'm okay, it's not owing me anything again, I will report it as revenue, even though no performance obligation has been met. But he said, I'm not disturbing him again, just leave him. You know, first of all, we want to establish with that whether oral or written or implied there is a contract. Do you understand? Whether oral, written, or otherwise there is a contract. Then two, we know that a contract exists in the first place. Two, I have paid you for what you want to do to me, but you didn't fulfill your obligation, right? And I said, well, that is how the guy behaves. Leave him, I'm not disturbing you again. You as the accountant, you will have been privileged to that information. Either your boss just as it's pressurizing, report the amount as revenue. He probably has heard an information that you are not privileged to. Then the auditor will now come and say, let me have a third-party confirmation. If it is possible for me to reach the contractee, I will reach him, circularize. If it is not possible for me to reach the contractee, I will reach the lawyer. If it's not possible for me to reach the lawyer, I will then say, you, the contractor, give me a letter of representation. There's something we call letter of representation in audit. Just attesting that all this information you have given to me, they are true, correct, and you have not given it to me under duress. So should in future I find out that, or anybody found out that what you have given to me is not true, you'll be solely responsible. Is that clear? Then the contract has been terminated and the consideration received from the customer is not refundable. You understand? I can still go ahead to recognize. Otherwise, the consideration received shall be deferred. If all of those conditions are not met and I still have the money, there is still possibility that that man can still chase me tomorrow. Do you understand? I will not report it. The standard says don't report it as revenue. Rather, defer it and report it as a contract liability. Is that clear? So we fulfilled one part of it, then the second objective, recognition criteria. How then do you identify the performance obligations? Of course, it is as implied, orally agreed, or written in the agreement or the contract. But just like he also rightly said, there are some agreements that will not in details provide the obligation of each person, each of the performance obligation and all that. That's when your professional work or competence now comes to play. I know we have a contract, I will then engage you. What are your obligations? You can then give to me. Do you understand? Maybe those who are drafting the contract are not experienced enough, or they are drafting it with a mutual understanding that, oh, Tomiwa is my guy, he won't disappoint me. Just sign for signature's sake. And I often tell my clients that as long as I'm still your tax consultant or your auditor, when you are going into some major agreements, particularly as a tax consultant, because I want to know the tax implications and advise you beforehand, involve me. Do you understand? But before you can get to that level when they will always involve you, you must have displayed your professional competence, humbly, not arrogantly. And also, not everything is a fee. If you have to charge them every time they say, call, you say, Adama, the moment you see the contract on now, 1 billion. So those are the things that could make them to also put you off. Give them some of these services, you just do it to earn their loyalty. Do you understand? Not everything you as the employee, reporting accountant, you will see. You go and tell your other colleagues, oh my Oga has the money, he doesn't want to pay. It will not involve you in some things. Do you understand? But if he can earn your loyalty that not everything Tomiwa or Lizzie hears, that she will go and tell the other colleagues, and they will now form a luta saying, Oga, we heard you have won another contract, increase our salary. Do you understand? Otherwise, without these things, you will not be able to discharge your responsibility. Why do you think most of them, particularly in the SMEs, why do you think most of them, even when they know that you are the accountant, they will still not show you their bank statements? They'll just be giving you figures. Report that one. If you like, don't report it. That is your wahala. Okay, let me see the invoice. What's your business? Am I going to use salary? Until they earn your loyalty that, oh, this guy will see the inflows and the outflow as a business, and not a condition for plea for a looter or whatever, they won't open up to you. But as they gain that, they will now be reasoning of, it's part of me, I understand that. You know why I can kill a cow in his presence and he will never mention it outside. You understand? So not everything is money, agitation. Sometimes some things you do to build what you call your social capital. You get it? So having drawn with with all of that understanding, we can then say, how then do we identify the performance obligation? Identify the performance obligation in the contract. Performance obligations are promised in a contract to transfer to a customer goods or services that are distinct. The performance obligations that the customer, that they promise to transfer the good, transfer to the customers is either that you have a promise to either transfer a good or services or a bundle of goods or services that are distinct. Sometimes you just have a single obligation. Prepare accounts for me and each person goes their way. Make this building construction one-story buildings and we don't see again. Just go your way and go my way. Or a bundle of contract. We have 7-story building of 10 different blocks. That is a bundle of services. So you need to be able to establish that you have that, right? Then, or a series of distinct goods or services are substantially the same and that they have the same pattern of the transfer to the customer. So that is when you can now say, oh, I have a performance obligation. Let's now break the whole process into pieces. An entity transfer controls of goods or services over time and therefore satisfy a performance obligation and recognize revenue over time. You know, I said it earlier on that there should be timeline towards as contained or enshrined, expected to be enshrined in the contract, right? So if you have a distinct goods or services to be delivered over a time, 6 months, as she said, 1 month, 2 months, I can then simply recognize what my performance obligation will be and the consideration that you crystallize from that. But if it's an indefinite, open-ended, we will need to do some other assessment before we can. So if one of the following criteria is met, the customer simultaneously receive and consume the benefit provided by the entity's performance as the entities perform. Do you understand? If I'm delivering a single good or service or a bundle of goods or services over within a specific period of time, then I should be able to identify when the customer receive that goods or take control of that goods and when my consideration is expected to have been performed. Do you get that? If I'm to sell a laptop to you, and that is what my performance obligation should be. At the time you take possession, now look at it, the customer simultaneously receive and consume the benefit. You've taken possession of it. So I have done my part. Then the second thing says, the entity's performance create or enhance an asset, for example, work in progress, that the customer controls as the asset is created or enhanced. So you have the control. And I know that, oh, what I've done to you is something of value to you. That's what we mean by enhance an assets. It constitutes a value to you. That's what we inform you, encourage you to willing to say, okay, you've done your part, let me fulfill my part too. Right? Then the entity's performance does not create an asset with an alternative use to the entity. And the entity has an enforceable right to payment for the performance completed to date. What am I saying? I have not sold a good to you that I will in another way come and use. let's assume I render, you said you needed some laptops. I render 2 buckets of service to you. I seconded some staff to you that are fully under my control, but to be of service to you. Then you then say you also want to you want me to sell laptops to you. If I sell the laptop to you, I assume that I've sold the laptop to you that my staff in your office will use. Then I've not done anything of value to you. Do you understand? Look at that interpretation with this. The entity performance does not create an asset with an alternative use to the entity. Anytime I use entity, I always say is the seller. If I said I'm giving something to you that I am having an indirect benefit, then I've not done anything to you. You can have reason why you should not pay me. That's my point. Because after all, you just say, after all, is it not your people that is using it? So what we are saying is that my performance obligation to you should give rise to an asset to the customer, not an alternative use of asset to me. Do you understand? So that is the area we also have to look at in any contracts that you are giving, to be sure that we are not using Peter to rob Paul. Like that, you remember we said something in lease when we say sales and lease back does not constitute a sale. That is what we are saying. I've sold it to you. I'm still taking it and I want to report the earlier proceeds from the sale as revenue. It's not done, it's not revenue. I'm just using Peter to rob Paul. That's what we are saying. So I would rather recognize that as loan or whatever, whichever one. And because I've then been able to discharge my own obligation, that is when I can have the courage to say, okay, you are owing me now. What's wrong with you? Pay me my money. Do you understand? So that's what that part is saying, that let's go over it again. You will then be able to say you have identified your performance obligation when any of these things are there. The customer simultaneously receive and consume the benefit provided by the entity's performance as an entity performed. As the entity performs, right? You receive value for what you have. Then, the entity's performance creates or enhance an asset to that customer. Then 3, that supposed asset that I assume that I've created with my service or goods to that customer is not of alternative use to me. And I have an enforceable right for payment for the performance completed to date. If those things are there, then we can say we've been able to identify the performance obligation. Like I know that this is what you are to do. This is what I am to do. Do you understand? The next one is determine the transaction price. I know there is a contract. We've looked at what makes a contract, what are the conditions of the contract, what also flaws a contract. If those things are flaws a contract are embedded there, you don't have a contract. Just forget it. Don't bother assessing or identifying the performance obligation. Then if that is fulfilled, let me now look at what are the things that constitute performance obligation. Somebody receives the value. That value constitutes an asset to the person. That asset does not make or constitute an alternative use to me. I can then enforce my payment, right? Then I've been able to identify performance obligations. There are still a lot of other factors, but within the scope and the timing we have for this session, this is what we can pinpoint as the most relevant one. Because if you have to look at this standard explicitly, it is not a 2 weeks presentation. If I had to dissect and be very, 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 very thorough, it's not a 2 weeks presentation. Is that clear? But with this in hand at your level, you can now consolidate as you have more experience, more encounter, more topical issues you then have. You can then say, oh, maybe this is not within the time limit of that session, we didn't handle that. What's your view about it? I'm open to all that. Is that clear? So next one is to determine the transaction price. But we will not bother determining the transaction price if those first two conditions has not been met. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or service to a customer. If the consideration promised in a contract includes a variable amount, an entity must estimate the amount of consideration to which it expects to be entitled in exchange for referring the promised goods or service to a customer. I hope that is very clear. Do you need any explanation on that? Good. Then the next one is, how do we then allocate the revenue to each of the performance obligations? I've said that performance obligation could be satisfied at a point in time. One-off service, I just service you, you go. You want to buy a laptop, I've given you the laptop, each person goes their way. Or it could be over time. Do you understand? For a 1-year retainer, 5 years contract agreement, 20 years contract agreement, and the like. The standard provides 2 methods for allocating revenue to each stage of obligation to contracts delivered. These methods are input method and output method. If it's a contract at a point in time, just use output method. Output method is your consideration at the end of the day. I know the value of what I've delivered to you. Then we go, right? But if it is a contract that is expected to be delivered over a time, then I will then need to be able to identify what value should be to what I have done, because the contract, performance obligation is still in progress. You understand? So I will then have to use input method. I may still use output method for those over a period if I can identify what is the fair price or fair value of each of the stages I have completed. But in the absence of those objective information, I will just want to recover the cost I have incurred to date. That is the meaning of the input method. Is that clear? So still on that, for a performance obligation satisfied over time, an entity would select an appropriate measure of progress to determine how much revenue, using either input or output. I've explained the conditions given that could give rise to that, should be recognized as the performance obligation is satisfied. Otherwise, revenue received in advance of the fulfillment of the performance obligation will be deferred. That is reported as a contract liability till the completion of the discharge of control to customer. What did I then mean? To the point when that customer can then say, oh, I'm satisfied with what you have done. I've taken possession of it. It's constituted an asset to me, and there is no intended alternative use to the entity. Is that clear? Or am I too fast?
Let's say, for example, now laptop, you sell that out. Sometimes you have to go back to
no, but those ones you will see that they are distinct services. The sales of laptop is different from the configuration of laptop, except where at the beginning we said sales and installation. Do you understand? Sales and there are 2 different services. Yep. Yeah, anytime we use the entity, we say we are referring to the seller. Now, even if I have a contract, a bundle of goods or services to be delivered, which is like that one now, is it in any way benefiting me? What I mean by that third condition, let's go back there. The entity's performance does not create an asset with an alternative use to the entity. I don't give you something that it is me that I still want to use it in the long run. Even if I sell that laptop to you and you are bringing me back for installation, it's still not useful to me. It is just maybe like other non-monetary service that I just want to render to you, or it will be at a different fee. Oh, how? Who will use the laptop? The laptop that have the installed software at the end of the day is the customer. It's not you. The moment you can interpret it that I will still have a benefit, you don't have a contract. I'm just using Peter to rob Paul. Sales and leaseback. Who is fully who? I told you I don't need this laptop. I sold it for you to you 600,000. And I came back to you to lease the laptop from you. There is no sales in the first place. I only borrow money from you. That is what it means. You get it? And that is why I would like to make reference to my funny illustration. Marriage is not a sales. It's not, there is no contract. When you marry the lady in the first place, they say, we have given you. Let the parents have a need of their daughter. Maybe they want to have a family function. And you stubbornly say, you will not go. You will see whether it is you that owns that asset or not. They will be piling it up for you. The day they will show you as irresponsible in-law, you'll be surprised. So in the first place, that marriage contract is not a sales. Do you understand? It's not a sales. Because they gave you their daughter for an expected alternative use. They will come during this Salah period now, they are wherever, whether Muslim or Christian, they will have been calling you. We just say we should greet you. My nice in-law. They're expecting something. You don't give, they'll be looking at you. So they are giving you their daughter for an alternative use. You will be, whenever they have a family function, you must be there. If I have gone somewhere to buy a slave, will the parent of the slave be coming to me that, for what now? So it's not a contract. That's what we mean by that alternative use. You get it clearer now? I rendered an audit service to a client. I gave the audited report. Who will use the report? Is it useful to me as the auditor? No. But if it is somehow useful to me, I have a contract that I want to use the company's name to defend that contract, and I needed the audit report, then I have alternative uses. The person can then say, I'm not paying you, Joe. No, it's a different thing that I say. But you see, it is a different thing. There is the branding may not bring a specific value. Do you understand? This one, I know as I'm going now, I'm reaping a value from it. The other one, I'm just saying, I have you as a client, I've done audit for you. The person that I'm telling that I've done audit for you, no sense. Come on for you. But if presenting it give me an automatic gateway, and I'm doing it for that purpose, the customer does not have any need of it. I'm just using the client to service myself. Is that clear? Okay, so the last part of it is then the recognized revenue when performance obligation is satisfied. Revenue is recognized when performance obligation is satisfied by transferring a promised good or service to a customer, which is when the customer obtains control of that good or assets. That is when you can say you have satisfied the performance obligation. That is when you should truly and honestly recognize your revenue. If that function is not delivered in 10 years, that advance payment to you becomes a contract liability to you. You are owing them because they can come back and say, "Wetere my kudi." How do you say it in your language? Okay, what? Kilishi. Don't mind me, I'm just joking. Sure, you understand? So a performance obligation may be satisfied at a point in time, strike that time with a number. Typically, for promise to transfer goods to a customer, or over time, typically for promise to transfer transfer services to a customer over a defined period of time. So as at accountants in practice, whether in the industry or in practice proper, this should be the decision criteria for you to know when to apply IFRS 15, how to apply IFRS 15, and how to make the presentations. Do you understand? I've been able to tell you that, okay, when there are several buckets of services to be rendered and they are not related, separate them one after the other. You should be able to have, okay, then there is one other one that I didn't mention, but it's a bit advanced level. When you now have to render services and the customer will pay at a later date, longer than 1 year. If it then happens, then it then means that you have used your fund to render the service, which should be compensated for. So you can then have what we call finance elements. And it will be done similar to how we did that of what do you call it? IFRS 16, because you then have to know what is the finance component of that revenue. If such occurs, separate it. You need to disclose them separately. Those are advanced level. But why you don't see it reoccurring is that most of those obligations that we see that crystallize into revenue are obligations that are expected to have been compensated for within 12 months. So the standard says that if it's obligation that will be settled or expected or probably to be probable to be settled within a period of 12 months, you don't need to account for, because the risk of inflation, changes in the cost of capital within a year will have been not very significant. So, any question?
Now, for that point means at the point customer what if during the process of customer?
Okay, so that would then take us to our earlier condition of the contract. There are some contracts you get and they will tell you that it's not refundable. The moment you pay and they give you the good like this, you are on your own. We don't have an obligation. Do you understand? But if it is enshrined in our contract that, oh, there's a warranty period, within that warranty period, in our earlier recognition, if there are warranty period, you will have used our, I said something earlier on that We will then apply what we call expected valuations using that probability theorem. That to say that out of every 10 things we sell, there is a possibility that from experience, one will always have fault. But we don't know when or who will have that one that will have fault. Otherwise, we'll say for you alone, let's understate what you will recognize as revenue until when that fault now occurs. We don't know who will have that one. So we will use our probability decision mechanism to determine what will be the probability of certain complaint that will warrant further cost occurring. So if our probability decision criteria is about 95%, it then means that out of every goods we sell, expected revenue from it is just 95% of the total value. We will defer the other one as a contract liability until the expiration of that contract period. If at the expiration of the contract period, nothing occurs, they will now write it as an income. Do you understand? Then some businesses will say, that is when I also cited Samsung, that they will always have insured that risk. If I had insured the risk, it means I don't have the obligation at all again. I can recognize, at the point of sales, I will recognize my whatever. If complaint then comes, I'll just direct them to the insurance company who will then bear the risk. It then means that that portion that I could have deferred as a contract liability would have been used to take the insurance policy. So I will have that expense in my book too, and everybody goes home. Other complexity that we also address is the area of giving loyalty reward. So I will then know what components of, there's a lot of probability estimates involved. It is peculiar to companies that give that kind of services. It's common in the consumable industry, the spa and the likes. They do all those loyalty at work. So we will then, what the standard is then telling us is that if they sell to you goods worth 10,000 naira, their revenue is not 10,000 naira. Do you understand? We will have used some analysis, some simulation will have gone under to know what portion of, what value do you want to give over the period that will worth X, Y, Z. So the value will be deferred. Do you understand? So if we say we are giving a loyalty of 1 naira out of every good of 10 naira you bought, we are deferring that 1 naira as a liability, as a deferred liability. We will defer it across all the sales of that range that we made. By the time anybody now clock that threshold and comes back to claim the loyalty, right? Where do we get the payments for? We then go and write it. The value of that goods will then be written off from the deferred liability. Do you understand? We now write it down to the income. So in each of the cases that you have, you just then have to just look at each case per case and see what is the terms of the contract. If your contract does not show any loyalty reward and every other thing, you can, and you have fulfilled your one-time performance obligation, recognize your income. Is that clear? Yeah. So that is on the minimal level what you are expected to know. But like I said, the avenue is there when you can then engage for other questions. So what I will then have to do, maybe during the week or before our next class, I will then share with you some of those spotlights of estimates, how to do some expected valuations if you have those variables embedded in a contract. I'm trying to get some, I don't just want to solve regular questions. I want to get practical scenarios that we can now play with. So I'll share that with you when I lay my hands on some of them. But at the moment, I don't have any clients that have those peculiarity. Do you understand? But on a lighter note, the big deal there is just to know how that probability simulation is made. Do you understand? Which is usually from experience. The first time you are doing it, you will not be able to know. You probably will have reported everything as income until when the claim now comes, we didn't book for this. Do you understand? So, but if companies don't want to take themselves through that long route, right? Just insure that risk and everybody goes to play. Let's just be that insurance will carry that wahala. And if you know that you don't want to, the clients don't want to subject themselves into that rigorous calculation of a loyalty award, right? Then don't make promise that you cannot deliver on. But should they make such promises, that promises is just a function of how much discount are we giving to the customer on each value of the goods. It will have been, it could be a back-end information, management information to say that, okay, because we want to encourage people to buy more, and because that is just intention, that is the intention, we want people to buy more. Out of every bottle of this thing you buy, how much are we differing, holding in trust that you will come again, you will come again, you will come again. Some of those people that have better field experience will also give you a timeline. That loyalty award will not be indefinite. They will tell you what you can do within 2 years. If you hit this point within 2 years, then, and also look at it. They will also not tell you when you hit the point, because it's a back-end information that they are using at the end of the, in their own management decision making. What they will then do, what most of them do, like the likes of Adide, SPA, is to then open that loyalty point for utilization at the end of the year during Christmas. So it's either when you now say you want to come and buy another goods during Christmas, and then they look at, oh, you have now had a point that qualifies you for a phone. They will have reserved the phone for you. So as you come, when you are now making the payments, they will just say, your loyalty award has reached XYZ, qualifies you to a phone. They will also give you an option. Do you want to redeem it with that phone, or you want us to give it to you as a discount on what you are buying? Sorry. Hello? Yeah, what's up? More, I love you. Somebody wants. Okay. Sure, you get it. But that is entirely how it works. It's as openly straightforward as that. The complex thing there is maintaining the customer's ledger. Because it's not just loyalty award we are giving to everybody. Having a database to maintain the customer's ledger such that you can read the loyalty award of each person. You understand? That is where, but a lot of companies may not want to keep themselves through all those rigorous process of maintaining those back-end data. They will just say, for all of our customers or people that have entered the shop within so dates or so dates, we are giving 1 cup of or 1 bottle of beer to everybody. So, but the unfairness is that is that people who have never patronized you from the beginning of the year might still come in and say end that thing, or except where you have been keeping track of your highly patronizing customers. So when they come, you don't give it to them in specific times that, okay, we want to reward you for always coming and all of that. Do you understand? So that's how it works. So that's where we will end this session today. Please, I will suggest that the discussion continues. I will add you to share your number with me. I will add you to your WhatsApp group. And even after the training, we will not dissolve the WhatsApp group. We want discussion on all of these areas to continue so that as you have topical issues among those things we have done, throw question there, I will attend to it immediately. Do you understand? So that's it.
If possible, how do you recognize that when one is supposed to be after a day, but deliver and when it was delivered, it was rejected by the customer. Now, the relative is not recognized.
Yes, but it's straightforward. The customer trusts you that you can deliver on certain good or services before they engage you. So the question is, that complaint that gave rise to that return, is it something that is rectifiable? If it's rectifiable and you know that you have not fully discharged, you also want to redeem your corporate brand. So let's assume I did something now, render it service, and I noticed that there is an error on the report. And the customer complaint, I will willingly collect it, not minding what the revenue will be. So, I'm so sorry, correct it and give it back. Do you understand? That is not really a something that could give rise to a serious concern. If you have not delivered on something, it's a different thing when we are now arguing on, I have a different expectation, you have given me a different expectation. That is a different thing entirely. And that is why in practice, what we do is that when you appoint us as your tax consultant or your auditor, we will always respond to that your appointment with an engagement letter telling you what our understanding of your engagement is. Do you understand? What are your own responsibility? What should be our own responsibility? So in the case of that disagreement, we will now make reference to that terms of engagement. In the regular business world, we call it terms of engagement, but in practice, we call it engagement letter. So that engagement letter will then help us to unravel the difference. Is it that it is you that preempts me of what I didn't agree with you? Or it is me that actually did not discharge all that I agreed to discharge with you? Or is it even that you did not give me all of the information that I need to even play my part? Do you understand? It is also different from the situation whereby we have a long time or overtime contract and we have discharged, you are not complaining about it, but you also did not pay over a period of a year, more than a period of a year. I will then, the standard now says that I will then have to factor. You know, most of the time, this is how it works. Even if you cannot pay now, we'll have agreed that, oh, for a reason beyond my control, I'm not going to pay you this until 3 years before now. Do you understand? It's not that you just keep me in the dark. Because if you keep me in the dark, I will have recognized the whole of that as revenue. But if you already have it in contracts, in agreement that I have some client that will tell you, Cole, do this service for me, but I'm not paying you now, not even this year. I have clients who are still owing me 2 years ago. Do you understand? If it is agreed from the very inception, you will notice that businesses will say that, oh, if regular paying upfront or paying as I went due is 1 million naira, I would then say your own is 1.7. So what the standard is saying, that 700 should not be reported as regular revenues, you report it as a finance element. Do you understand? If you just disclose everything as revenue, you are misinforming the public. It's a finance element that you will then have amortized over that period. You will be earning it as a period dues. Earning it as a period dues. The implication is this: if you then say in your first year I've earned 1.7, you are just exposing yourself. I will disclose, have I fulfilled my performance obligation? Yes, 1 million, bam. But finance interests, first year, maybe 250. Second year, 250. If the payment then becomes another deferred, I will then, because the agreement I say, for as long as you continue to defer it, it is additional 250, exactly. Yeah, why not? Yeah, I deal with you. Mo wà l'office báyìí. Mo ṣe lecture kan lọ́wọ́ ni, but mo ti parí nsìn. Where you dey? Okay, so how do you want to come, or I should come to your side? Okay, come now. Come, my dear. Around. When you feel one, so that by the time you come, we'll have finished and we can talk. Thanks. Sir.
I remember back when we have done construction to.
Sorry, can you repeat that again? I lost.
Okay. Now I'm going to share the fact when we were when I was in construction that there's a new recognition, especially when you huge the contract with a particular milestone, not that you're not paid, but you a particular milestone, and then you're still in talks in the position with the client as regards whether the client will accept that particular milestone and the types of needs and inputs for that particular milestone. And then you, of course, your material cost, definitely, your material expenses, cement, diesel, bitumen, and all that. But the customer, the client has not certified that particular milestone, then those expenses will be deferred as a deferred cost. Because you can't buy them off the period. So those expenses will defer cost.
Okay, that was as at when? Which year?
What?
Okay, so as a last year, if you are differing it, I'm trying to look at which standard you're using. Do you understand? So if it is construction, you then be using IAS 11. What does IAS 11 even talks about that? IAS 11 does not say you should differ your cost.
So you write it off when they do revenue to market.
You recognize what scenario you might, then what we then do is to get certificates of valuations, understand, which will then inform what's the valuer, the value the valuer has attached to that milestone you have attained. So that valuation will then inform what is the proportion of your revenue recognition and your profit at the end of the day. Do you get what I'm trying to say? If you also remember very vividly, that method also does not talk about your revenue recognition. In fact, that valuation only informed what the customer will pay. We tell you what the customer will pay, which should then be the net of the cash price. The valuation the customer, the valuer gives will inform the cash price after the mobilization, which they will then deduct. The standard says you should then deduct 10% as a retention fee. But the calculation that the standard gave then was about recognition of your profit or loss. If you remember, it's not about your revenue. Your revenue is always the cash received less retention fee. Do you understand? That was one of the pitfalls in IAS 11 that IFRS 15 wants to redress, that don't center on the profits. Let's look at the revenue. If you then match your revenue with your cost, if you then result to profits, that's your cup of tea. Do you remember? That is the pitfall there. So as at that time you did that, I think it's good when we have a mental shift behind what everybody just do, the industry practice, and we having a basis for what we do. There's a lot of things we do in practice that is actually wrong. People just say because everybody does that. Why do we do that? That's one of the hallmark in our firm. If I give you a work and you did it or you make an opinion, even if it's an opinion I know about, I will still ask you what informed that your decision. Because we don't just want to continue to train zombie accountants. I'm sorry I use that word. Right? I just go in the public way, right? But know why you are doing what. Is that taking? Know why you are doing what, so that it becomes very embarrassing when a client engage you and they ask you, why do we do this thing? And you say, that is how we do it in our office. Why do you do it? You say, that's how we do it. What is the reason? What informed that decision? You ask my boss. It shows the person is not well informed. So our teams are trained in such a way that even in my absence, they can handle any issue. That's our number one objective. You work with that intention. And that is further to portray the fact that we should see each other not as employer to employee, but as a partner in progress. What also make people have that perception of nonchalant attitude? I call it nonchalant attitude because most people, even amongst the accountant, they just say that maybe I'm working for my salary. Whether they like it or not. I make my team to know you are not working for me, I'm not working for you. You are working for yourself. Because if you have that perception, you will take the job with an ownership mentality and you want to know everything that is relevant to you. Not just I give you a letter, you just go and submit it. One day I'll give you a letter and tell the person they will receive, just arrest that guy. You know what they used to do to us when we were young? If you are distracting the elders when we are growing, they just tell you, tell them to give you a rundown. The meaning is just that this guy is disturbing me, help me keep him busy till when he's tired. So we should have that mental shift to having a lot of ownership mentality. It helps you in the long run. You understand? Because you will not just live each day by how much are they paying yourself. But if you know that your life is dominated in the time, and as you are going to work, you are not spending or earning that money, you are spending the currency of time as your life. You want to have value for each day. You understand? I'm not going to office or coming here because you paid me XYZ. I'm coming in here to add real value to myself. What I thought today, I knew it much more than when I was actually preparing for it. Because a lot of things has been said here, a lot of person has been said that I never even envisaged. So if you have that mental shift in our work, in our daily life, trust me, 5, 10 years, you'll see more value to yourself. I tell my colleagues when I was still in paid employment, when anything happens, and most of them will be saying, this employer, they are just cheating us. They're not cheating you. This work where you get is a privilege. It's not a permanent entitlement. And I'm very intentional when I introduce myself and I said, I'm the managing consultant by a privilege. It's a privilege we all have. I grew my team to know that I may not be there tomorrow. It could be you. So that is why you need to know why we are doing what, so that when you get there, you will not be a zombie MP or MC. And even if you are not here and you are doing your own thing, you will have gained so much value that no money can actually buy. I wish you all the best.
Thank you very much, boss.